There is a number that does not appear on any tax return. It is not hidden in an offshore account. It is not buried in a shell company in the Cayman Islands. It exists inside a perfectly legal financial structure that has been operating in the open for over a century. And every year, it quietly transfers more wealth from one generation to the next, without a single dollar being taxed. The people using it are not criminals. They are following the rules exactly as written. That is what makes it so important to understand. Think about how your income works. You earn a salary. Before it reaches your account, a portion has already been removed. Federal taxes, state taxes, payroll taxes. By the time you actually hold your paycheck, the government has already taken its share. Then you try to save what remains. Maybe you invest it, maybe you put it toward a house. But if those investments grow and you eventually sell them, the government collects again. This is how income works for most people. You earn it, you pay taxes on it, you save what survives, but there is a second system, and it does not work this way at all. Or because they donate to charity and write off the deductions. These explanations feel satisfying because they suggest the gap is about cleverness or misbehavior. Close the loopholes and the problem disappears. But the real mechanism is not a loophole. It is not aggressive. It does not require offshore accounts or complicated structures. It requires understanding three things: what gets taxed, what does not, and how to move between those two categories without ever crossing the line. In the 1990s, a law professor at the University of Southern California named Edward McCaffrey began teaching his students about this gap. He gave it a simple three-word name: buy, borrow, die. His colleagues dismissed it as too simple, too blunt. Then in 2021, ProPublica published a leak of confidential IRS records. The records showed that America's wealthiest individuals had paid effective tax rates that were fractions of what ordinary wage earners paid. Some had paid nearly nothing for years at a time. McCaffrey had not been oversimplifying, he had been exactly right. The first part of the strategy is accumulation. Instead of earning traditional income, a salary, a bonus, dividend payments, wealthy individuals focus on owning assets that grow in value. Growth stocks that pay no dividends, private company equity, real estate that appreciates without producing rental income. As long as those assets are not sold, no tax is owed. The value climbs, the government watches, but until the moment of sale, nothing is collected. This is fundamentally different from how most people build wealth. A teacher earning $60,000 a year pays income tax before she can invest a single dollar. A warehouse worker putting money into a retirement account pays tax on every paycheck first, then invests what remains. But someone who owns a business stake worth $10 million and watches it grow to $15 million over 5 years has paid zero tax on that $5 million gain. Not because they evaded anything, because the tax code does not reach unrealized appreciation. The wealthy do not avoid the tax, they simply never trigger it. But there is a practical problem with holding appreciating assets and never selling them. You cannot pay rent with unrealized gains. You cannot buy groceries with a stock certificate. At some point, wealth has to become liquid. This is where the second phase of the strategy operates, and where the real structural advantage reveals itself. Banks will lend money against the value of investment portfolios. These are called securities-based lines of credit. A wealthy individual with a $2 million portfolio can walk into a private bank and borrow against it, often 70 to 80% of its value, without selling a single share. The loan proceeds flow directly into their account. They can buy a house, fund a vacation, invest in a new business, cover any expense they choose. And none of it is taxable income. Borrowed money is not income under the tax code. It never has been. When you borrow against a home, no tax is owed. When a business takes a loan, no tax is owed. The same principle scales to any asset. The interest rates on these loans are typically low. Wealthy borrowers present minimal risk to lenders. Their assets are collateral. The larger the portfolio, the more favorable the terms, sometimes as low as 2 or 3% annually. Now consider what happens while the loan is outstanding. The portfolio continues to grow. If it earns 8% annually and the borrower is paying 3% in interest, the net result is positive. The wealth compounds. The borrowing capacity increases. The cycle can continue indefinitely. The borrower is living off debt, but their actual wealth is growing untouched in the background. Consider what this looks like at a concrete scale. Someone who has built a business and sold it walks away with $1 million. They invest that money in a diversified portfolio of growth assets, not for income, but for appreciation. No dividends, no distributions, just compounding value. At a conservative 7% annual return, that portfolio reaches nearly $2 million after 10 years. almost $1 million in gains that have never been taxed. If they were to sell those assets today, they would face a significant capital gains bill, federal taxes at 20%, state taxes that can add another 5%. On a $1 million gain, the tax exposure could reach $250,000 or more. Instead, they borrow. A securities-based line of credit at 70% of portfolio value provides access to $1.4 million in cash. At a loan rate of 6.5%, the annual interest cost is roughly $90,000. Compare that to the tax bill they avoided. If the portfolio earns 8%, $160,000 in annual growth, and the interest cost is $90,000, the net annual gain is $70,000. The borrower is coming out ahead while living off borrowed funds. This is the part most people never calculate. The math does not just allow this, the math rewards it. The final phase of the strategy is where the accumulated tax obligation disappears entirely. When someone using this structure dies, their heirs do not inherit the original cost basis of the assets. They inherit the assets at their current market value. If a portfolio was worth $1 million when first purchased and has grown to $8 million at the time of death, the heirs receive it as if it were always worth $8 million. Every dollar of appreciation that occurred during the original owner's lifetime is erased for tax purposes. The outstanding loans can be paid off by selling a portion of the inherited assets, tax-free because of the stepped-up basis. Whatever remains belongs to the heirs without capital gains liability. The original owner lived for decades off borrowed money. The loans accumulated. The assets grew faster, and at death, the tax code resets the entire history. The scale at which this operates is difficult to visualize. Securities-based lending is not a niche service. It is a standard product at major financial institutions, quietly offered to clients who meet certain asset thresholds. Most programs require at least $1 million in investable assets to access. Premium programs require $5 or $10 million. Once you qualify, the system actively rewards you for having more. Interest rates decrease as portfolio size increases. Borrowing capacity expands. Meanwhile, a family earning $60,000 a year pays effective tax rates that often exceed the effective rates of individuals controlling assets worth hundreds of millions. The teacher and the warehouse worker do not have access to securities-based lending. They earn income. They pay taxes on it. They save what remains. The political conversation about this rarely reaches the core issue. You cannot tax what is never sold. Understanding this system changes something practical about how you think about money. Not because most people can immediately access securities-based lending. The entry point requires substantial assets that take time to build, but because the logic underneath this strategy contains something transferable. The wealthy do not try to earn their way out of taxes. They try to own their way into a different relationship with income. They accumulate assets that grow without generating taxable income. They delay the moment of realization as long as possible. They treat debt not as a liability to avoid, but as a tool that can be used when the math supports it. The first step, even at a smaller scale, is the same. Stop thinking about wealth as income. Start thinking about it as the gap between what your assets produce and what your life costs. When that gap becomes positive, when your assets grow faster than your expenses, the system starts working differently, not like a billionaire's portfolio, but in the same direction. There is a number that does not appear on any tax return. It is not hidden. It is not illegal. It is simply structured in a way that the ordinary tax code was never designed to reach. Most people spend their lives inside one financial system, earning income, paying taxes on it, building wealth from what survives. That system is real. It works, but it is not the only one operating. The second system does not advertise itself. It does not require fraud or conspiracy. It requires understanding that the rules were not written the same for everyone, and that the gap between the two systems grows wider the longer you do not know it exists. If this changed how you think about money, subscribe to The Threshold.